Oh,
Never done it.
Oh, so now you're talking through your phone and not your computer?
Yeah, we're going to be all full live.
Okay. How do you guys want to start it?
I'll start it off like I always do. Ladies and gentlemen, welcome to the first episode of Pounding the Table Live. We got our boy Jonah Lupton in the house alongside myself. This is Avi, and then Shai and Joey. And for those that can't, since we just did this on a whim here on a Friday, 5 minutes to go, we'll also be recording this. So if you guys have to drop off and have work, totally understandable. But let's kick it off. Jonah, I know you wanted to touch on a few of the earnings this week. There's some big ones. Celsius, we have to kick it off with, I'd imagine. I know you wanted to touch on that. They just announced a 3-to-1 stock split. Have a ton of new flavors. I always use my bodega as a kind of a microcosm of where it's at. And I've started off with 2 in the corner. And now they have, I think, 12 flavors or, whatever. They have pretty much every flavor in the dead center. And so that's been a cool microcosm to watch. But you've been on this stock since day one. I think you and Joey were the first 2 stockholders of Celsius.
And Joey got in before me. I got in, I think Joey's been in since low single digits. I got in around $10, obviously in the 170s right now. And the stock hasn't really done anything since earnings, but I'm not worried about it. I mean, the stock's been a absolute beast for the last 3.5 years. It probably has to digest some of those gains. It's still up like 70% year to date. And I can just look at the fundamentals and sleep well, knowing I have a big position and everything still looks pretty strong. They reported earnings this week. The challenge now is that Celsius is no longer a secret. For a few years, this stock really flew under the radar. The analysts were way behind the story, and there wasn't even that much coverage to begin with. But over the last 6 to 12 months, you've seen a lot more firms pick up coverage. I know that Celsius management is always talking to these analysts, big funds, the big asset managers. But when they reported Q2 earnings, they blew it out of the water. I think the estimate was somewhere around 276 million. They came in at 326. So they beat it by 50 million of revenue in Q2. And then not only did they beat Q2 by 50 million, the analysts then raised Q3 estimates by 50 million overnight. So going into Q2 earnings, the Q3 estimate was 300 million. 2 days later, the estimate had gone up to 350 million. So it makes it harder to keep doing these big monster beats when the analysts are finally catching up. They still beat it. They came in at, I think it was 378 million or 376. I forget. I think my number was 370. I think they came in at 375 or 376. I guess management said something about there was like 15 or 20 million of pull forward. Well, guess what? There was 15 or 20 million of pull forward a year ago. When we started working with Pepsi, there's going to be another 15 or 20 million of pull forward in Q4 as these Canadian distributors or Pepsi starts to bring product up to Canada. When they roll out in Canada, there's always pull forward. It's like the stupidest reason to sell the stock right now is that there's some pull forward. There's always going to be pull forward. At the end of the day, Celsius is growing revenues by triple digits still. And I think the most impressive part about this growth the past 6 or 12 months is just the improvement in margins, gross margins, net income margins, EBITDA margins. I thought maybe we'd end this year at 11% net income margins. We probably have a shot at 13, 14% net income margins. So this is going to be a pretty powerful earnings growth story for the next 3, 4, 5, 6 years. I mean, of course, revenue growth is going to slow down. You can't do triple digits every single year. This will be the 3rd straight year of triple digit revenue growth. And I heard someone on Twitter saying that, they do think Celsius will be the next Monster, but Celsius can't grow at Monster's pace. I mean, Monster never had a triple digit growth year ever. So, they just did a lot of like 15, 20, 25% years. What Celsius is doing now is just phenomenal. So US growth is going to slow down, of course, but we'll have international growth going forward. So international revenues is like 4.5% ballpark of total revenues. Over the next 4 or 5 years, I think that number can get up to 15 or 20%. If I remember correctly, like I'm not looking at my investment model right now, I believe in 2027, I have them doing 5 billion of total revenues. And I believe 18% of that would be coming from international. So Canada, Europe, Asia, South America, etc., Australia. Monster and Red Bull both do 40 to 50% of their revenues outside of the US. Just like 3 years ago, there was a lot of white space in the US for Celsius. Now there's a lot of white space international. And just like the US consumer has really, caught on to Celsius and moved away from other energy drinks, I suspect the same thing will happen in international markets. So I'm excited to see what happens. Pepsi's obviously opened up a lot of new doors into food service, which is hospitality. So hotels, like if you walk into a hotel, and there's like a little gift store there, there's usually a cooler in there, and Monster and Red Bull have really dominated that. Now you're going to see Celsius in those coolers, not to mention colleges, hospitals, airports, music venues, concerts, stadiums. None of those doors were open before until Pepsi came on board, on top of all the other brick and mortar doors they're opening. And then, of course, Amazon's still doing pretty well. I think that was like 70% year over year growth. Club channel still doing great. Costco, Sam's, BJ's. I believe some of these clubs now have 2 full pallets of Celsius. But I will say, what they're doing right now with their 200 milligram can product is great, but they do need to start expanding the product lineup. So I mentioned on Twitter, this is my new favorite flavor. So Celsius just announced the Essentials, which is the rebranded heat product. So you can now pick these up in 7-Elevens, and then they'll do a full rollout either later in December or January. There's 4 flavors right now. I think it's dragon fruit, blue crush. This is orangesicle. And then there's was it cherry limeade maybe is the 4th? I forget. But this orangesicle is unfreaking believable. Like if you ever had orangesicle, like if you used to eat those orangesicle popsicles as a kid, it tastes exactly like that. Like it's absolutely incredible. So before I tasted this product a few days ago, my favorites were lemon lime, which I'm drinking right now, green apple, cherry, tropical vibe, orange. But I think this orangesicle is hands down like the best drink they've ever made flavor wise. So
I have made you a spokesperson. John. I've always wondered.
I want to be on the board of directors. So I do think, 280 milligrams of caffeine, or actually, 270 BCAs. This is closer to what Bang was before they shit the bed. I don't think many females are going to drink this product just because of how much caffeine is in there. I think guys like us that have probably a high caffeine tolerance will drink these probably on the way to the gym or at the gym. So I do think the market for this is smaller. I need them. I'm talking to management next week. I am going to be very adamant. We need 100 milligram can. There are so many people, mostly females, but some males, that do not want 200 milligrams of caffeine. That's too much for them. And that's fine. I could probably drink a 200 milligram can and go to, take a nap an hour later. Not everybody can. So that's like low hanging fruit. Like all of the high school girls, the college girls, the millennials that love the product, just want a little bit less caffeine. That 100 milligram can, we need something for them. Plus Canada has more strict laws or restrictions on caffeine. I think it's 180 milligrams in Canada. So I'm saying just do 100 or 120 for Canada and then use that same product in the US. Celsius already has 20,000 coolers in the US, their own branded coolers. If you're going to put tens of thousands of your own coolers into stores, you need more than one product in there. So I want a 100 milligram can next, and then I want a hydration product. Prime is freaking killing it right now. Killing it. Because the younger generation doesn't give a shit about Gatorade, Powerade, or Body Armor, which are like the 3 kind of giants in that sports drink, hydration, intra-workout space. Prime came along with a shitty drink, so many chemicals, tastes like piss, and they're going to do $1 billion in revenue over the next 12 months. It's ridiculous. So I know Ghost is coming out with something. I forget, Monster might have something. I think Monster does have something hydration. Celsius needs to do it. They have the brand capital now. They have the ambassadors, the influencers, the commercials. Like you have Pepsi. That's probably the last like straw. It's Pepsi. Pepsi's probably holding it up because they own Gatorade. They probably don't love the idea of Celsius having their own hydration drink and then putting it in the same coolers with Gatorade. But I look at it as, dear Pepsi, like your consumers are out there drinking Prime, Body Armor, Powerade. Powerade and Body Armor are both owned by Coca-Cola. So Coca-Cola has a lot of hydration drinks in their coolers. Pepsi only has Gatorade. So like I would think they almost want to have a second hydration drink in there. I actually went to CVS the other day, and in the bottom of the Pepsi cooler, which actually pissed me off, the bottom row was Prime. So like get that shit out of there and put Celsius's hydration drink in there when they create something. So like kids are drinking Prime. Like when I went back to my parents' house on the Cape, I asked a bunch of high school kids in the gym, like, what energy drinks are you drinking? One is Celsius, two is Ghost. And then for hydration drinks or during their workout, it's all Prime. And they don't even like the product. They admit it tastes like shit. They drink it because it's like the cool drink for kids. And I honestly think Celsius could really dominate that market if they get into it.
So you see about this super early, as we were talking about. Now, at the price where it's at now, I'm curious to see how you take a look at that. Because I've been in situations where I've bought, CrowdStrike at 60, and it was just so hard for me to buy it at 200 again, just knowing. But like, how do you look at this now? Are you buying more? You have a ton, but are you kind of sitting on that, or are you looking to buy when it drops a little bit?
Yeah, I mean, I did a lot of adding earlier this year when the stock pulled back into the 80s. I think that was right before Q2 earnings. So I did a lot of buying, took my position up. After they crushed it on Q2 earnings, I trimmed my position a little bit. So I'm just sort of trading around my core position. I did hedge my position. So into Q3 earnings, I did buy some puts just to hedge my position. Not that my long-term investment thesis was in any danger or just, you never know, these quarter-to-quarter hiccups, like you just never know what to expect. I'm up over 100% year to date in my investment portfolio. Like I'm not trying to screw anything up with 7 weeks left in the year. So, but I already sold the puts the next day when the stock popped and then dropped, pulled back. I sold the put and I actually did add to my Celsius position. So like if I didn't have a position right now, I would probably start a small position like in the 170s and then add on pullbacks. I mean, I think next year, so what's funny is one of the analysts that just came out with I'm trying to think. Like, unfortunately, not many analysts actually updated their numbers or price targets after Q3 earnings. I think Morgan Stanley went up to 195 price target. Piper, someone went to 250. I forget who it was. So their 2024 revenue estimate was 2.1 billion. And then I think it was 3 billion for 2025, which was actually even higher than what I had. So I think it implies like 60% growth next year. I'll just like run through my Celsius numbers real quick. So I have 1.3 billion this year, which would be 100% year over year for the third straight year. Next year, I have just over 2 billion, which would be about 57% growth. And then 3 billion on the nose for 2025, which would be 46% growth. At the same time, they're increasing net income margins by 1 to 1.5% a year. So if they're growing revenues by 57% next year, 46% the year after, you're going to see EPS growth will be even higher than that. So the stock should continue trading at a premium multiple. I saw someone on Twitter saying that Celsius should trade at 30 times earnings, which like I just couldn't help but laugh when I saw that. I mean, and my reply was, yeah, they'll trade at 30 times earnings when they're actually growing earnings by 30%. I mean, they're growing earnings 300% this year, and they'll probably grow earnings at 90 to 100% next year. Like, that's not reasonable for them to trade at 30 times earnings right now. They'll trade at 30 times earnings in like 2027, 2028, when they're actually growing earnings at 30, 35%. So, I mean, I have them at 53 times earnings in 2025, 49 times earnings in 2026, 45 times earnings in 2027, because that's basically like a 1 to 1.2 times PEG ratio on those years. So, I mean, we'll see. I could be wrong, but if you look at Monster and where their margins were as they scaled, I mean, Celsius isn't even close to them yet. So there's still a lot of room to grow those margins. Before the pandemic, Monster had gross margins over 60%, and they had net income margins, I believe, at like 25%. Celsius is, like I said, this year they'll probably end up at 12 to 13%. So there's a lot of room to go on those margins. And they don't actually manufacture their own product. So Drink Pack, I don't know if you guys saw the tweet last night that I sent out. It said Drink Pack is one of their co-packers, and they're actually building 2 new facilities. They're spending $450 million to build 2 new facilities. And I believe Celsius is their largest customer. And that's probably one reason they're doing it. Like, they see the writing on the wall. They see how much growth is coming. They need to be ready for it.
Let's move on from Celsius, since you just hit on every single thing there, Jonah. Unless, Joey or Shy, you got something quick. I know we wanted to touch on TMDX that absolutely ripped through earnings. So, Shy, you want to kick that off? Or
Yeah, I can kick it off with TMDX. I know Jonah was the other bull on TMDX. I've been pounding the table on his name for like weeks, like even 1 or 2 months. And I know Joey likes the name as well. This is just such a great growth story. There's very few stocks in the market that's worth under $2 billion that also have this insane amount that's expanding with the network effect via that aviation acquisition that they just did. They're about to be free cash flow positive. They're growing their top line like gangbusters, like triple digits, like another similar triple digit story growth. And they just absolutely delivered in their earnings report this week. A lot of heartburn in the market was like, oh, is Ozempic going to really bring them down? Is this aviation company going to really extend their path towards profitability? A lot of noise, that exactly what we've been preaching like on the pod. Like, this is just noise. Like, this is a great opportunity. We were pounding the table below $40. I think I would hit $60 this week. I still think this is a $100 stock next year. And I think there's just so much runway for this specific company in the coming years. I mean, they had to acquire this aviation company. Like, they're growing so quickly that they couldn't afford to go to their brokers to get these, to lease these planes and all that stuff. Like, there was just so much demand that they had to own the whole end-to-end process. And that's exactly what they did. So that's what you want to see in a young growth company, is just, there's so much demand, that there's such a dominant network effect and moats that they're just going to experience short-term headwind of this acquisition that's going to probably hit their bottom line slightly. But again, the top line is going to be triple-digit growth this year. I think like 40 to 50% next year. And it's just such a great story to be part of. I know I'm going to let Jonah add some more color to that, but I could not be more happy to be a TransMedics shareholder this week.
So I first found TransMedics in early 2021, and back then they only had lungs approved. So there was a lot of risk in the story because they had to go through the FDA panel and advisory panel. Like, that is, like, I remember sitting through those meetings. It is brutal. I mean, it's like an entire day of the FDA advisory panel asking questions and poking holes at the trial. And then there's a vote. Like, it's wild. All of that's behind them now. So now they have approval for their OCS units, which stands for Organ Care System, on lungs, heart, and liver, with kidneys probably coming in the next couple of years. And the difference is, if you say you die, or, you're an organ donor, your organs are harvested and put into a cooler, which is cold storage, which means your organs start dying right away. So you have a finite amount of time to get those organs into the recipient before they are, you can't use them. And the longer you wait, the more risk there is to the recipient not taking those organs successfully, rejecting them. Versus what these OCS units can do is, it's warm perfusion. So they're keeping that heart, the lungs, the liver, they're keeping it alive. Warm perfusion, that means warm blood, nutrients pumping through those organs to keep them alive for hours and hours and hours, up to like 12 or 15 hours, which means that if you have someone die in Boston and the perfect match is in San Diego, you can now stick that organ into an OCS machine, put it on a plane, and fly to San Diego and save that person's life, whereas you wouldn't be able to without OCS. Now, The financials are pretty simple to understand, like outside of the aviation. So they bought a company called Summit Aviation, basically because the CEO says we're growing so damn fast, we cannot rely on charter services anymore. Like when we have to be able to move an OCS unit from one city to the next, we can't not have access to a plane because there's so much effing money in this business. So they're making $100,000 of revenue per OCS procedure. So if heart, lungs, liver goes into an OCS machine, on average, it's $100,000 of revenue for TransMedics. They can't afford to lose that revenue because there's no planes available at that specific time. And they're going to make money on the aviation part of the business as well. It's all reimbursed by insurance. So like it's a juicy margin business. Obviously, aviation is probably going to bring down margins a little bit, but it'll increase revenues. And like Shay said, they are growing this year at about 150% year over year. But the CEO has basically laid out the path. So this year, they'll do around 2,000 procedures. The new guidance is about 240 million, but like just using round numbers, about 100,000 of revenue per procedure. He says over the next 5 years, they can get to 10,000 procedures, $100,000 each. Now we're talking $1 billion in revenue. I think 5-6 years from now, net income margins are probably in that 20 to 25% range. If you look at other med tech companies at scale, that's typically where they end up, in that 20 to 25% range. Shockwave is approaching 20% right now. So I think there is a lot. I mean, not only is the top line going to grow at 35, 45% for the next 5-6 years, you're going to see margins expand dramatically. They would have been profitable this quarter if it wasn't for the cost associated with the acquisition. So they'll be profitable next year instead, most likely. They'll at least be EBITDA positive next year, hopefully GAAP profitable next year as well. If they're not, though, it's just the integration costs associated with the aviation business. So I'm super bullish. Like all the risks that were in TMDX 2 years ago are not there anymore. They are the market leader in this. There's really nobody even close to them. I also think this is a potential acquisition target for Medtronic, Boston Scientific, Johnson & Johnson. I mean, now the TransMedics has really proven themselves. They have all the FDA approvals. Now they have the aviation business, and the multiple's very reasonable. This was not even an expensive stock when you look at the fundamentals.
That's crazy. It's under $2 billion right now. It's 188 right now.
Yeah. I mean, the stock was up. So at the highs, so they reported earnings. I think was Tuesday night? I forget. Tuesday night, maybe Monday. I don't know. The stock was up 70% at one point the next morning. If you had bought, so just if you want to punch yourself in the face after you hear this, feel free. I did. The November 17th, 85 calls the next morning were up 8,000%. 8,000% the next morning. So if you just put $1,000 into those 85 calls, November 85 calls, you would have 1,000 to 80,000. So, I mean, the stock has pulled back a little bit. I think it closed up 51% that first day after earnings. It's pulled back maybe another 5 or 6% from there. But the long-term story is intact right now. I wish there was more analysts that covered the stock. Unfortunately, there's only a few. Most of them have price targets, though, anywhere from 80 to 100. So, I mean, everyone believes there's more upside left here.
Love it. Joey, you wanted to talk about the surgeons on the career page?
Yeah. So one thing that I always like to look at companies is you can take a look at, their careers page, and you can kind of see something that they might be doing to bolster growth going forward. So you see that they acquired this aviation unit. So yeah, now they don't have to wait for planes or book someone else's. They own their own fleet. But a cool thing that I found on their website is they're actually hiring surgeons. And one of their listings is cardiothoracic organ procurement surgeon. So one thing you could see them doing in the future is they would actually have a bunch of these surgeons on staff. So these are regional hiring. So they'll have a surgeon in each region. So now if there's a transplant, their surgeons, a TransMedics surgeon will go procure it, put it in the OCS system. get on the TransMedics plane, fly to the recipient, and whatever surgeon procures an organ will also put it back in. It's just one of the, I've talked to surgeons before, and that's just how it works. So if they've got them going and retrieving it, then this same surgeon puts it in. It's essentially they're creating an end-to-end transplant as a service.
They're like vertically integrated. Now the revenue per procedure goes from 100,000 to like 250,000.
Yep, they get to bill all that, and it's just, you can kind of see where this is going, and it's such a futuristic type feel that it's very impressive what they're building. And I feel like if they get this whole staff of surgeons, then yeah, this thing, when you're looking at the market cap size, the growth, this could be a significantly larger company.
There's so much money in transplants. Like the average transplant, I believe, costs somewhere between $300,000 to $500,000, and the insurance companies pay it because it's cheaper to pay $300,000 or $400,000 to get that person a new heart than like all of the other health services, related to someone with a, dying heart. That's more expensive over a 15 or 20 year period. So it's like buying a new car now versus holding on to your old car that breaks down every year and you have to keep paying to fix it. It's cheaper just to buy the new car now.
That's a cool stock to invest in too. It's not like
very cool
investing in cigarettes or, like this is actually helping humanity as well. So there's a feel good story behind that.
One last thing, 3 weeks ago in our newsletter that gets sent out every week, this was one of the 3 stocks to buy before November. So it's not too late, but I'm telling you, there's a lot of runway on this stock.
And I think you can still buy it here. Like I wasn't recommending buying it when it was up 70% the next day, but now that it's pulled back to, where is it right now? Like, it's back under $60. Like I agree with Shay. I think this could be $100 stock in the next 12 months.
Somehow wrote the ticker symbol down, but it's still winning. I meant to do SMCI, but I typed SCMI, but that's still won. So you want to talk about Supermicro?
Yeah. So, these are my 3 highest conviction ideas right now. They're about 40% of my portfolio. So it's Celsius, Supermicro, ticker SMCI, and TransMedics. I think all 3 of them have phenomenal fundamentals, reasonable valuations, and a ton of upside to go. Obviously, we covered 2 already. The third is Supermicro. They're like a hardware supplier to the AI chip. So NVIDIA, AMD, Intel. Obviously NVIDIA right now is the king of AI chips with their H100s. AMD is launching their, I believe it's MI chip in early 2024. Supermicro already has a partnership with them. And then I assume Intel will have their AI chips at some point. And we know the hyperscalers, we know Meta's working on AI chips. We know Amazon's working on AI chips. Microsoft's working on AI chips. Google, they're all going to have their own AI chips at some point. So that's one reason I don't want to buy. NVIDIA is a phenomenal company. I owned it in my trading portfolio, but I think NVIDIA is going to have a lot more competition over the next 3 to 5 years. And I think all of those companies are probably going to work with Supermicro for their hardware, their cooling technology, and everything else that they can bring to these companies to make their chips more productive, more efficient, save energy costs, blah, blah, blah. So companies based in Silicon Valley, they do some manufacturing outside of the US. They recently announced their fiscal 2024 Q2 earnings, beat and raised. They raised guidance for Q3. I forget the exact number. They raised full year guidance though from 10 to 11 billion. This is a company with a market cap of like 12 or $13 billion. 9% net income margins. They'll do 10 to 11 billion in revenues this year. So they're trading just above 1x sales. And the CEO has said multiple times, he thinks this company can get to 20 billion revenues within the next few years. And they're in the process of building a new manufacturing facility that would be able to support that growth. So if TSM, the big semi-manufacturing company out of Taiwan, they said AI chip demand will grow at 50% a year for the next 5 years. And that's the nice thing about Supermicro is I don't give a shit who's AI chipped or going into their hardware. They're going to have partnerships with all the big companies. So I think that this is just the tip of the iceberg. I know they're a hardware company and hardware companies sell at lower margins versus software companies. but I don't understand why Supermicro trades at such a low multiple. Their new guidance implies like 45% revenue growth, about 40% earnings growth, and the stock trades at less than 15 times next 12-month earnings. Like, it just doesn't make sense. But I mean, I think the market's wrong. I think the market will have to catch up eventually. Maybe they need a little bit more proof. And we'll see. There's a lot of conspiracy theories around NVIDIA that some of their funding startups, and then those startups are using the cash to like come back and buy AI chips. And we don't know exactly like what the risk is going to be selling these AI chips into China. Apparently NVIDIA is coming out with 3 new chips that will not be banned into China. So like, obviously whatever bad news is surrounding NVIDIA, like that will also spread onto Supermicro a little bit. But I think we're going to continue to see strong growth, assuming they can, keep up with it. Thank God the supply chain problems are over. Obviously there's risk, they do manufacture some stuff in Taiwan. If shit goes bad in Taiwan, all the semis are going to get smoked, including Supermicro. But they also do manufacturing in the US and Europe. So hopefully something went bad in Taiwan. I guess what would happen is if NVIDIA is making all their chips in Taiwan and there's an invasion, then, you don't have any chips to stick in the hardware anymore. But we'll deal with that when it comes. I mean, for now, I just think at these prices, and I would absolutely be adding the Supermicro at these prices after we just got that last quarter with new guidance.
Awesome. Shai, I know you wanted to add a bit, and then let's wrap it up with TTD, because that was quite the fall yesterday.
Yeah, I can make this quick. So I know a lot of people are bullish on the data center thematic, but they don't know what stock to invest in because semiconductors goes over a lot of people's head. And it took me a lot of hours to actually look into it to figure out the differences between the companies. Supermicro Computer is the best way to capitalize on the tailwinds of the data center thematic because they're the perfect pick and shovel play of that thematic. And we talk about all the time on the pod, like, you love a specific concept or thematic, like the pick and shovel play is the best way to play it. And Supermicro Computer is that. And I do think there's a disconnect between fundamental valuation and like what the market is like pricing it to be. So definitely a stock to watch in 2024.
Yeah, I mean, if Supermicro was trading at 50 times earnings, I would not be interested in it. But at less than 15 times earnings, I just think it's way too compelling not to have as my second biggest position. And then real quick, my fourth highest conviction idea right now is probably On Running. Because I love the sneaker. It's my favorite sneaker and I'm like a big sneaker head. Everyone I know that's tried On Running loves them. Hoka would be second. Hoka's owned by Deckers. They just had great numbers a couple of weeks ago. I think Hoka and On are both taking market share from Nike and some of the other legacy companies. So when On reports earnings, I think it's next week, I would expect good numbers. If the numbers aren't blowout, it's because Europe and Asia are seeing a slowdown. Like, I think the US numbers will be phenomenal.
Joe, you were shaking your head. Do you want to battle that one or?
No. So, I mean, On Running, you can't argue with the growth story, everything. My issue is I had some On Running shoes and then I went to my local Fleet Feet and tried on the Hoka Clifton 9s, which I'm going to convince Jonah to order. And those things were life-changing. I just wish I would have gone and tried them on before Decker's earnings because it would have been the indicator for me to hop right in. Because, I mean, go get your feet scanned, see if Clifton 9s are fit. But yeah, those shoes, absolute game changers. But yeah, there's no arguing the growth story at On Running.
I mean, like, to me, those two brands are so far ahead of everything else. It's not even close. I have 75 or 80 pairs of sneakers in my closet, no joke. And the only ones I wear on a consistent basis are Hoka and On. Like Nike, toe box is too narrow. APLs are good for some things, but some of them suck. Same with Noble. Noble, I think, is their sneakers are way overrated. Like Hoka and On are going to dominate this industry for the next 5-10 years.
Yeah. Allbirds were good at first. I like the tree runners, but then I tried on the On Clouds and I switched over.
I think Allbirds is a penny stock now, right?
Yeah. Allbirds is a mess, like the stock wise.
And then Adidas Boost were my old.
What's crazy about, so Hoka, so Deckers bought Hoka for, I think it was $1.5 million or $1.1 million, like 8 or 9 years ago. And this year, Hoka will do about $2 billion in revenue. And if they spun out Hoka, it would probably be an $8 or $9 billion public company. I mean, Decker's got the steal of a lifetime. It's like a 4,000 X return. It's crazy.
That's what Pepsi is hoping with Celsius. Is Pepsi going to acquire Celsius?
So I get that question a lot. I mean, obviously, I don't know. At this point, I don't want them to, because I think there's enough growth over the next 3 or 4 years where I would make more money on the stock over the next 3 or 4 years than just a quick 30 or 40% premium in a buyout. It's like, it's tricky for Pepsi. Like, does Pepsi really want to, like, the better job they do growing Celsius in the US and international, the more it's going to cost them if they just will acquire them. So, like, I do wonder if their incentives are really aligned for that reason or not. You guys have to get off for another interview, right? Sweet Green?
Yeah, we got, so I was going to say, I was going to go to TTD, but I don't want to.
Now, one thing about Pepsi is when they acquired Rockstar in March 2020, I was working at a big company. I remember turning around to people talking to me and saying, such a dumb deal. They could have bought Celsius at the time. I think maybe like $250 million. Celsius was trading like $5 a share back then before their breakout quarter. I think it was in May 2020. But I feel like Pepsi's they're going to be hesitant to make another big deal in the energy space because they've crapped the bed so much. And that Rockstar deal was just terrible. But I mean, they did get a good stake at a good price in Celsius. Now it's just the stock's run so much that it goes from being, a relatively large deal to a massive deal if they go to acquire this. And I feel like they're going to be very hesitant to fork over $20 billion to make it happen.
But here's the thing. I mean, eight or 9 years ago, when Coca-Cola invested $2.1 billion into Monster, Monster's valuation then is bigger than what Celsius is right now. And Monster still went up 4X from there, right? Monster was I think the valuation was around 15 or 16 billion when Coke did that deal, because they did like 2.1 billion for like a 16% stake, and Monster is 60 billion now. Like, I honestly, and I'm not even saying this because it's my biggest position, honestly think Celsius could be a $60 billion company someday. Red Bull and Monster together, Red Bull's privately held, but Red Bull's probably worth even more than Monster. They do even more revenue. So together, those two companies combined, I mean, 130 billion in market cap, 140 billion in market cap. Celsius is 12. Like, there's still much more room to go. So, like, anyone that thinks that the story's over, you're too late, like, not even close. Energy drink market is massive, and it's growing at 10% a year.
It's crazy to see, the actual growth. I remember when I first invested in Celsius, they did a little over $5 million in annual revenue. And they now do that every 2 days.
Oh, yeah.
So just to see where they were and where they've gone, it's incredible. And I feel like John and his team over there are going to figure it out. And a big thing for them getting to that $50-60 billion is going to be continue to expand that product line, like you said, into hydration, into more categories, because they've got that brand loyalty and just the rave about them with the younger consumers that if they launch another product line, they will buy it.
I have them getting to 10 billion in 2031, but like 25% of that revenue is going to have to come from other products, maybe even more than that. Like, it's going to have to come from a hydration drink, a 100 milligram can, etc. Okay, you guys got to go, right?
Yeah, we're about to interview the founders of Sweet Green, which has been devastated as a stock. So we're very excited to connect with them and see what they have planned.
I ate Sweet Green last night, actually.
There you go. So if anyone has questions, shoot us a DM, give Jonah a follow. He doesn't have it quite enough. He's only got like 500,000 or so. So
join my stock quits room so you can make some money.
There you go. We'll give him a quick shout out. But we'll start doing more of these. This is pretty dope. So I enjoyed it. Hopefully everyone did as well. And if you guys have questions for Sweet Green, shoot us a DM and we'll give you guys a shout out on that episode. We'll do more of these in the future. But thanks everyone for tuning in. And Jonah, appreciate you hopping on, man.
You got it. See you guys later. Have a good weekend.